This video will cover the instruction for homework 2. And homework 2 is about weighted average cost of capital. So this is for chapter 3. We learn how to calculate weighted average cost of capital from raw data. So weighted average cost of capital has a couple of components. So we have E, which is the market capitalization of the firm, and D is the market value for debt, and we're using book value to proxy for that. And also, moving on, we will have this cost of debt and cost of equity. And finally, and this is the tax rate. And for cost of debt, we use two methods, method 1 and method 2. One relies on historical information, and the second one will use the market yields. Going for cost of equity, we learn basically two models. One model is dividend growth model, another model is capital asset pricing model. And we're going to cover it and use all of them in the homework. So going to the question 1 in homework. So question 1 will ask, what is the cost of equity of this public listed firm? And we have the information for the current share price and its current dividend. Over the past 5 years, this dividend has grown annually at a pretty high rate, 22%. A respected analyst assumes that the current growth rate of the dividend will hold for 5 years. After that, the dividend will be stabilized at 5% annually. So as you can see now, there are two dividend growth rates here. Initially, the dividend will be growing at a very high rate, and then later on, after 5 years, it will tend to be stabilized at a lower rate. So this is dividend growth rate 1 and then growth rate 2. So for the Excel, we don't really have this two-stage Gordon model, and we actually need to use user-defined function. And the code here for this user-defined function is provided in the lecture slides. And I believe we have already covered how to understand the code here. Basically, there is loop here. So we're using the top checking loop using loop while. And you can also change it to loop until, and you can also here change it to other way of basically expressing the equation, so the formula here for calculating multi-stage dividend growth model. So I'm going to just use this function, but you are free to use your own way of calculating two-stage Gordon model, as long as your final results is consistent with the true value, or the they are close enough to the true value for cost of equity. So I'm going to go ahead and open the VBA. And I paste the code here. Now I have defined it, the two-stage Gordon. The first variable is price 0. Second variable should be dividend 0. So two-stage Gordon. First variable is price 0. Second variable is dividend 0, current dividend. Third one is high growth rate. Fourth is high growth year, so 5 years. And finally, the stabilized growth rate. Okay, so let's move on to the next question. So here we're actually looking at a case study. We're looking at specifically at one single firm, and that is Caterpillar. So Caterpillar now is, as you know, is a manufacturer of construction and mining equipment, and you can read all of those. So here you will find a supplementary material that is Caterpillar's 10K filings. So 10K filing is basically its financial statements over the year. And also I have provided another filings that Caterpillar made to their shareholders. That's like a presentation trying to summarize all of those key KPI, and also trying to showcase their shareholders how was their performance over the years. And you can read through all of them, and that will be very helpful for answering all of those following questions here. Now I'm going to focus on the technical part, like the calculation, and I'll leave the discussion part to you, and you can explore more and providing your own analysis and your own insights for Caterpillar in year 2020. So I'm going to focus on here. So first question A will need you to read item 1 in 10K filings of CAT, and you can easily find item 1. So go to the content, and item 1 is here. So then you will be able to answer the first question. How does Caterpillar break down their business segments? And the next question might need some of your calculation, and this is pretty simple, how to calculate the capital structure of the firm. You don't need a very precise measure here. So if you can go to the lecture slide, we have an example for Starbucks capital structure. So it has total assets, and the way of financing is total asset can roughly break down into liability, So debt financing and equity financing here. Now, of course, this is a very rough calculation. We are not disentangling any financial assets from operating assets. So just give a very brief and very simple calculation for the capital structure. So you just need to go to the balance sheet and then calculate how much percentage of debt that Caterpillar has over total assets, and then how much of them is due to the equity part. So give this to percentage for question A. And then for question 2, extract information from 10K, calculate and report the following numbers: implied tax rate, net debt, and also growth rate of equity payouts. So for all these information, this is related to question 2, TC, which is the tax rate, and RD, which is the cost of debt, and G here for equity payout growth. So you can see now we have nothing here in this spreadsheet unless except for this years and variables here. So I'll need you to go to the financial statement, the 10K, and find a specific item here, input the number here, and do your calculation. Now I'll give you an example for calculating this tax rate. So I'll go to 10K. Now this is the table of contents. So usually we can find financial statement here for financial statement and supplementary data. Scroll it all the way down. So here I will need income before tax and income tax expense. If you're really familiar with the structure of financial statement, you can be very confident which financial statement you can find income before tax, and that will be income statement. I'll first go to income statement here and want to find income before tax. So usually it will be here. So after you calculate the sales, calculate the costs, calculate the operating profit, you get the number for profit before tax. So here is the numbers for 2018, 19, and 2020. So now you need to notice that it will be a little bit confusing that the order here is actually not really matching. So what I'm saying here is you have 2018 here, 19 and 20. So here 2020 is actually on the very left column. So just don't mess all the numbers here by simply missing the years. So I'm going to manually type it. So 3995. Then calculate the implied tax rate, which should be the marginal tax rate. That means it's not the average tax rate that the firm pays for every dollars. It's the marginal tax rate that the firm will pay for every additional dollars. So that means average tax rate will be lower, the marginal tax rate will be a little bit higher. And the formula here, if you're not sure, go back to the slides and also go back to your lecture notes or the textbook. Make sure that you understand the formula here. So for the tax rate, we always want to use the tax expense divided by income before tax. Okay, so that's implied tax rate. So now next is net debt. So again, we need to find information. Here we need to find cash, short-term debt, long-term debt, net debt, income, and interest expense. Now let's first try to find the most simple one, which is cash. So cash is located in the firm's balance sheet. So I'll go to balance sheet here. Okay, next, let's find short-term debt. So the idea here, I think I have explained it in class. So let me just go back. The idea here, we want to only keep the financial liabilities. So even you have seen that under this short-term liability, there are account payables, taxes payables. So we're not going to include these operating liabilities. We're going to only include short-term debt and current position or current portion of long-term debt. So that's the short-term part, and also adding this long-term debt here. So that will be all the debt that we are taking care of. So I'll just go to liability in the balance sheet, and I found current debt here. So under current debt, I'm going to only include financial products. So depending on the structure of this balance sheet, the way that the firm is presenting, so some firms will be presented in the way that shown in the slides, like in this way. You can see accounts payable, taxes payable, that is separated from short-term debt. Now for Caterpillar, as you answer question A, you're going to see that financial products or financial section is one of their business segments. So that's understandable that they put this together with machinery, energy, and transportation. But for our purpose, since we want to keep only the financial liability, so I'm going to highlight this part, highlight this part. And also this is under short-term debt, and also highlight financial product. And this is under long-term debt due within 1 year, which will be the current position of the current portion of long-term debt. And finally, I want long-term debt. And long-term debt is here, long-term debt due after 1 year, which is literally the long-term debt, financial products here. I'm going to add these three items together. So first input it here for 2019. So then we can start our calculation, which is equals to the sum of debt minus cash. So the formula here, we have explained it in class. The reason that we are subtracting cash, this is because first we're using net debt to measure the book value of debt. And the assumption that we have here is cash. We are not thinking that cash is an asset for operating purpose. So we're always going to assume here that cash can be used to pay off all those debt. So therefore, holding cash is essentially increasing the firm's cost of capital. So here we are treating cash as a negative debt. So going back, now we try to find interest income and also interest expense. So for these two items, it is usually under the income statement. However, in this income statement for Caterpillar, you cannot that easily find these two items before the calculation for taxes. For Caterpillar, for interest expense, here it is actually excluding the financial products, and we want exactly the interest that is related to financial products. So everything has been summarized in this item here. So now we're trying to find this item in the following more detailed explanation for the consolidated statement of all those financial information. So I scroll it down. So under this specific explanation for other income bracket expense, I found the interest income here. Okay, so I'm going to input the number. But we still cannot have the interest expense. Now you may wonder, do they have any interest expense? Here, for the interest income, it is usually due to the cash holding. And for interest expense, as long as the firm issued debt here, like this is not any number that is close to zero, then the firm should have the interest expense. They should pay some interest. So we just need to find the place where they list all this interest expense. One thing that you can do is you can just simply search the words here. It is located under the income statement. So for CAT, it puts under the operating costs. So I'm going to extract these two numbers here. Finally, do the calculation for cost of debt equals interest expense, which minus the interest income, which is the net interest paid divided by average, the average level of debt. The average level of debt from this year to last year. Enter. Okay, now that we can move on to the next question for calculating growth rate of equity payout. So go to growth rate for equity payout. For equity payout, let's go back to the slides. So there are two main ways for companies to pay out their earnings. One is through dividend. Another way is through repurchases. In some old days, company would prefer using dividend, and dividend has the typical features of having a very steady growth rate. But for repurchase, there's no such commitment for repurchase every year or every quarter. Company can just have launch some repurchase program or just can pause it later on. So it is not a strong commitment, but it's also, as you can see in recent year, it has been in a very higher, as you can see in a recent year, company are more likely to use repurchase to pay out to their shareholders. So let's just go to Caterpillar's cases. And we want to find the dividends and repurchase. So here, let's just search. Okay, under the cash flow statement, find the number we want. So for dividend paid, we can find the number for 2020, 2019, and 2018. And also there is information for common share issued, and this will be share issuance. So that means companies are raising more capital from the equity market. The way of doing that is to issue new stock shares. So here, repurchase number is also here, another way for company to pay out their earnings to their shareholders. So that's why for dividend payment and also repurchases, these are negative numbers. And for share issuance, this will be a positive number. So I will just extract all this information. Then I will start to calculate the total equity payout. And that should equals to the payout minus issuance. So the first two items is the earnings, the cash outflows. And the last, for the issuance, this is cash inflows, the capital that the firm gained or received from their shareholders. This is their shareholders' investment. The capital that the firm raised from issuing the common shares. So then I can calculate the growth rate based on the model here. So we want to calculate the annual growth rate. So that's why we're raising to the power of 1 divided by n should be here the number of years. Okay, from 2008 and 2020, don't confuse yourself. How many years between 2018 and 2020? So there are 2 years. And minus 1 here. So you're gonna probably get a negative number, since we can see clearly here from 2018 to 2019 there's an increase, but into 2020 there's a decrease. So you may want to provide more analysis in this case. I'll leave this part to you to let you figure out what's happening in 2020. So now you see this number here, and you may be a little bit suspicious about the calculation. So one way you can do is just to calculate. So I'm looking at 2018 to 2020. So how about just from 2019 to 2020? Now I even have a more negative number here. So here, I also want to know from 2018 to 2019. Okay, so I have 3 very different numbers here. I'll just leave it here and leave the analysis and the judgment for you to evaluate and reconcile these 3 different numbers later on. So then let's go back to the homework. Now that we finished question B, for question C, it's related to this spreadsheet here for calculating the dividend growth. So we first need to extract information about firm's historical dividend payment. So how to extract it, I provided the link here. So usually NYSE will contain all those information for the dividend. So you can just go ahead and use this link, copy all the information from the link, and then paste. Then we can start to calculate the growth rate. So here for growth rate over 8 years, how many years do we have? We first need to check that. So we have from 2013 to 2022. So roughly 8 years. If you want to find exact 8 years, so we need to be careful about selecting our timestamp. So equals should be dt. So dt is here divided by D0. So I should go for here. Or here. It actually doesn't matter whether I choose here 34, row 34 or 35, they are the same number. As you can tell from this graph, the dividend growth is very steady. It's going to be, in this linear trend here. So it doesn't really matter which ending point that you are choosing. You're going to have a very stable number for the dividend growth. So I'm going to just use these two numbers, raise it to the power of 1 divided by 8 minus 1. Similar here for using the data of just last 4 years. So half of the sample period equals here divided by, now should have 1 year, 2 year, 3 year, 4 year. So 19. Okay, and then these two numbers are pretty consistent. One is roughly 8%, another one is 9%. So then let's go down to question D. Download the adjusted close price for Caterpillar and the market using SPY from Yahoo Finance and calculate percentage return, plot the return, fix the line, display the model in scatter plot, attach the graph, and finally estimates the beta, report these statistical estimates, comment on the significance of beta alpha and the model, and finally calculate the risk-free rate, monthly market premium, and annual market premium. What we are doing here is we're trying to grab the information for calculating CAPM. So for calculating CAPM, we need firm's return, and we need the firm's beta, and we also need the market premium. So now we are calculating the firm's beta in this step, and we're calculating the market premium in this step. So now I can just go ahead to Yahoo Finance and find the prices of SPY. SPY is the ETF index for S&P 500, and also find the adjusted stop price for CAP. Now you can just try, go to Yahoo Finance, just adjust the data sample period and also adjust the data frequency to monthly. And we're using monthly data here. So, and then copy and paste the adjusted stop price. That will be adjusted close price in this case. So adjusted close price means that those prices has been adjusted for dividend and then also for stock split. So you don't really need to take care of the dividend payment and also the price effect of stock split. So here, let's just go ahead and start calculating the first question here, the percentage return. I'm calculating percentage return using this year's price divided last year's price minus 1. Okay, then I can plot the return of CAP and also S&P 500. Go to insert, scatter plot. I want to make sure X is X and Y is Y. Now to check that, select data, edit. What should be our model here? Our model here, let's just go back. Our model here is R equals to alpha plus beta times R. So this is called market model. It is a statistical model. It is very similar to CAPM, but CAPM has a lot of assumption there that, for example, the beta under CAPM should be a systematic risk measure, and all of those risks out there should be summarized by beta. But for the market model here, we don't have to use risk-free rate, and we don't really have any assumption. This alpha here can be positive. So as long as we can have the data for the market return, we're just trying to capture the correlation between RI and RM, and beta here measures the exposure for the firms to the market factor. So therefore, that means we're putting the RM, the market return, on the right-hand side as a dependent variable, as an independent variable, and RI here is on the left-hand side as the dependent variable. So let's just make sure that. So edit, so my X should be SPY, and that should be column F, correct. And my Y should be the RI, and which is the column G here, and that is also correct. click OK. So I also need to add the fit line to fit this data here. And before I add any lines, you can already observe some tendency here. That is, this has to be an upward sloping line, and the relation is quite linear in this case. So we should not be too worried about using other mode of the model. So I'll just go ahead and go to trend line, more option. I'll just select linear as the default, display equation, and also display the R square. So it looks pretty nice here. Go to calculating alpha. For alpha, it should be equals to this number here. So 0.0112, if you calculate that correctly. So I want to make sure what is the y's and what is the x. Y should be cat. And x here should be the market return. Enter. So let me just check 0.12, and it's 0.0112 here. The beta is 0.89, almost 0.9, and it's 0.9 here, so that is correct. So then I'll just need to calculate the R square, and I'm using, just copy the equation here, escape, paste the equation here, and just change slope to R square. So R square is 30%, which is pretty nice, a pretty high number already, representing a very good fit for the data. So then for the t statistic, now there's no default or built-in function for t statistic. So we need to find the code in our lecture slides. It is located in page 27. So we have two user-defined functions here. One is called t-intercept, and another one is called t-slope. So it will give you the t-statistic for intercept and slope. So I'll just go ahead and build this to user-defined function. Here, the user-defined function, you should be able to read the code here. This is very simple. It's just defining t-intercept. So we are using, we're just inputting the y arrays and the x arrays here. And t-intercept here equals to application.index. So we learned this. So here we are calling the Excel function. So the Excel function for, which is called this index. And then we're calling another Excel function, which is called lineness. And here, this is lineness, as we introduced in Excel techniques in that lecture. This is also a way to do the regression analysis. And for lineness, it offers more flexibility and also more complex to use. So you can do multivariate regression. You can call different statistic for the regression based on these number. So this number represents, okay, letting Excel know which one you want, which statistic related to the regression that you want Excel to output. So here we're using the estimate divided by the standard error to get the t statistic. This one you should learn it in your statistical class to do when you're doing your hypothesis testing. So we're testing whether, for example, the null hypothesis, which is the estimate, the intercept here, the alpha here is equals to 0. We test that hypothesis. So basically, we want to put the alpha here on the numerator minus 0 divided by standard error. So this is standard error. Okay, so I'm going to show you how does it work in Excel. So now these should be the Excel functions, so lineness and also index. So I can do this here. And just delete applications. Delete that. Change y arrays to cat. Change x to spy. Okay, I'm going to check here equals t-intercept. Okay, good. So this gives us the same number for t-statistic of the intercept. So now we can do the t-statistic for slope. Okay, pretty good. Okay, so this number should equal to these two numbers as in the VBA code. We are actually calling to use the Excel function here. Now for the next step, it is sort of a part of your homework that to figure out the statistical meaning for T. So is beta significant? Is alpha significant? Is the model a good fit? Now discuss this part. You may want to spend some time going back and reviewing some of the basic stuff you learned from your statistical class. And also, if you have time, I encourage you to learn how to use this lineage function. And a lot of time, the lineage function will use in coordinated with this index. Okay, so we don't have time in the class to cover this part, but if you know how to use this function here, that will be a big plus. It will be very beneficial in your further on when you're trying to use Excel to solving more complicated regression model. So finally, we want to calculate the market premium. So here, I want to first figure out the risk-free rate in December 2020. So the risk-free rate in December 2020 will be 0.09. So, well, here we want to show it in percentage. Now, does it really make sense to have a risk-free rate close to 9%? It doesn't. So you can easily grab this magnitude here. It should be in percentage already, like for this column. So here, let's try to measure it in percentage by just divided by 100. And then calculating average monthly return. We covered this in class for getting the idea of ER, so expected return for the market or the market premium. So we're using average return to proxy it. So here, average. To annualize it. Then we can move on to the last question. The last question will ask you to calculate the weighted average cost of capital. So we're gonna pull everything together in the last spreadsheet here. So first, let's try to figure out the shares outstanding. Now I have a comment here. You want to extract this information from 10K. So actually you can extract any information from 10K. Now let's just go back to 10K. And I want to search share outstanding. Okay, I got it here for 16 profit per share. Share outstanding equals to 545.3. I'll use 545.3. And then for share price, the share price is actually here equals. Now this says December the 1st. It is just the way of showing it, it's December's return, but it's actually I think it's the end of the date, end of the month price. So calculating equity return using number of shares times shares per price per share. Remember, this is in million, as stated here in million. Net debt we calculated before. And the tax rate. Tax rate is pretty stable, so I'll just use the last tax rate. Cost of debt. Expected market return. Annualized, it should be an annualized return because we're using all annual numbers from the 10K. Risk-free rate. So you may wonder, should we do any adjustment for making risk-free rate measured in annual basis? So the risk-free rate here that we're using treasury yield, and yield is already an annual rate. So equity beta. Okay, so equity beta is 0.9 here. So I want you to check one thing. So what is the equity beta for CAT that's calculated by Yahoo Finance? So for CAT, now it's also 0.9. So if your calculation is correct, so then your beta calculated from past 5 years monthly return should be pretty similar and consistent with the number that's shown in Yahoo website. So then I'll use 3 different methods to calculate cost of equity here. So method 1 is calculating cost of equity based on the Gordon model. So Gordon model is a model for firms that issues dividend. It is based on the dividend growth. And if the firm does not issue dividend, we may look at its equity payouts. Say it issues share repurchase. So or they do share issuance. Okay, we can look at the equity payout. If they don't have dividend, they don't have repurchase, we can also look at the CAPM, using CAPM to estimate the cost of equity. So we are summarizing different methods here, putting all of them together and calculate a WACC. And finally, we want to graph a number for estimating weighted average cost of capital here. So starting from the Gordon model, so for current dividend, it is contained in here, in this information we downloaded directly from NASDAQ. And for the growth rate, we calculate the growth rate already. The growth rate is pretty stable. Okay, you can just choose the most recent one or the over the entire period. That shouldn't affect your results a lot. So in this case, I have comment here, just choose more recent period. And finally, you can calculate cost of equity based on this formula here. And this formula is exactly the Gordon dividend discount model or the constant dividend growth model. So we are assuming that dividend is growing at a constant rate G. So the dividend is currently at D0. And we're assuming in all those future periods, it will be growing at this growth rate G. So we just need to use the current price in this for this equation. So then we can get the number for cost of equity. So that's this part. And then next, we're using Gordon equity payout. So we're using exactly the model, but we're just changing dividend to equity payout. So we're taking care of not just dividend, but also repurchase and also share issuance. So all 3 different methods for firm to pay out its earning or communicate with the equity market. So these are related to firms' payout policy. So some firms choose to issue dividend, showing that they have a strong commitment to pay out their profit. Some other firms may choose repurchases, or some firms may choose the combination between these 2. Now for repurchases, a lot of firms has repurchase program, but that's not a strong commitment as dividends. So it's less consistent, less commitment to this repurchase. So you can go ahead and refer this current equity back to the tab here, and currently it is at this level, roughly 3 billion. And then the growth rate, we calculate the growth rate, and there is it's hard to reconcile this growth rate here. Okay, I'll leave that discussion to you. I want you to provide some explanation here. And then finally for CAPM, so we have already the beta, we have the risk-free rate, we have the market premium, which is here. You can just input this formula here. And finally, first look at these 3 different numbers, and then trying to calculate the weighted average cost of capital, like average weighted average cost of capital. And if you find some outliers, we discussed it in class, you first need to look at it. What is the reason that is causing these outliers? Is it just a data issue? Now, in this case, it's unlikely the case because all those numbers is extracted from the 10K. If it's extracted from the 10K, then we probably want to know, the company's manager and the accountants and all those teams, they wrote so many words here trying to explain each of those numbers. Now you can go ahead and search what is their explanation for the numbers that you use. So why do we have some outliers, for example, for the equity payout? And then how do you want to decide the final weighted average cost of capital for CAT? Finally, to present your homework. So you want to open a Word file, start from the Word. So this will give you an example of how to finalize the answers to the homework. If you have any questions, please let me know. I'm here to help. And I also hope that you find this homework interesting and helpful for learning weighted average cost of capital.